My first question to you is related to the announcement earlier this week between the United States and China. This is the first time we get to hear from you, really, since the announcement of those two countries. And I'm just wondering how that event is perhaps changing the outlook for the European Central Bank.
Thank you. Thanks a lot for having me. Of course, every day brings something new. And in terms of the trade wars, it's good that people do take time. It's good that people do discuss because trade war at the end of the day is not good for anyone. And of course, it does affect the economy. Confidence is all over the place, quite weak, but it does not that much show up yet in hard data. So some of the damage could be controlled. But of course, we don't really know how it's going to play out. What's going to be the outcome of the talks of the US and China? How is this going to affect the European economy? What will we see with the output of Chinese economy? Is it going to be dumped into the European economy and all these things? So it's still very, very uncertain. And that just very clearly says that the modus operandi that we have at the ECB, meeting by meeting, is the very appropriate one.
We are used to hearing that those words, meeting by meeting, data after data. My question at this stage is, where do you think we will land in terms of potential rate decisions from the ECB? Because after that announcement from the US and China, as I highlighted earlier, Goldman Sachs now says that we're only going to see 2 more rate cuts from the ECB this year. What do you think of that? Is this a fair assessment?
I would not comment on the number of the cuts. We'll see going down the road, but I think there are a couple of important elements to pick up. One is the sheer uncertainty itself. And what does that mean, in my view? It means that there are lots of alternative scenarios. There are alternative scenarios how the economy can play out. And the probability of those alternative scenarios very often is not that different from the baseline scenarios. And that means that there are risks of non-linearities and jumping from one scenario to another one. Currently, if one takes a look at the dynamics of inflation, we are by and large within the baseline scenario. And if the baseline scenario holds, then I think we are relatively close to the terminal rate already. A couple of more cuts maybe, but the important thing is to see where does trade talk and trade story takes us, and then we of course will act. No need to rush. We have yet another meeting at the very beginning of June, together with the outlook update. And then we'll take the next step and we'll see how the things evolve further. Of course, we will have no idea yet how the trade talks, how those 90 days end up in June. But there are many more data points and many more decision points in terms of our meetings that we'll see down the road this year. But I would say, let's not jump on everyday news. Let's see how the things play out, keep calm and act when we see what the data tells us.
I'm also curious to get your thoughts on a comment from one of your colleagues, Isabel Schneider. She said that the appropriate course of action is to keep rates close to where they are today. You are highlighting very clearly that the uncertainty is very high and therefore it is hard to predict what the ECB might do in June. But I'm just wondering what your thoughts are in relation to her comments that we should keep the appropriate course of action is to keep rates close to where they are today.
What we've seen that inflation is relatively close to the forecast. Yes, we've seen some uptick in services inflation momentum, but still within the baseline. So if I would stand with the data that we have today, I think the market pricing for the next meeting is relatively appropriate in my view. But later on, we'll see. I think the timeline of many decisions is also of critical importance. What we've seen Germany becoming very vocal in terms of fiscal spending. We don't know how is this going to play out. Not this year, but maybe next year. And then the question is this going to come along with the structural changes? If the structure of the German economy is improved and European structure as well, then of course that means that more of this stimulus will go into output, less of that will go into prices. So all these elements currently are still big unknowns. So I think the visibility still remains relatively low, no need to rush, okay? And step by step, we will go to the terminal rate. And as I already implied, if we are within the baseline scenario, which is still currently the most likely, although the alternative scenario probabilities are quite high as well, then we are relatively close to the terminal rate, in my view, already. So it's very obvious within the baseline scenario that we reach 2% target within this year. And the dynamics and trajectory of the policy rates also would not require a large cuts. So it's a stepwise thing, a couple of moves maybe this year, but the uncertainty still remains high.
Very clear. I would also like to get your thoughts in terms of what we have heard thus far on the trade front. We have seen the US announcing an agreement with the UK that ultimately puts tariffs at 10%. And then with China, the level of tariffs for now at 30%. So analysts are saying that this is basically the bracket, the two levels to be looking at, the 10% and the 30%. If the EU negotiates something in between this bracket, what is the likelihood of a recession for the Eurozone?
The best outcome, of course, would be, and I'm pushing my luck a bit here, would be no tariffs at all, okay? Because that would be beneficial for everybody. But if we remain with some kind of higher tariff levels in the range that you highlighted, there have been estimates of that. Of course, that is a very high uncertainty story as well. The estimates for euro area of about 25% tariff would be up to 0.8%. But that is, of course, with a very large margin for error. But the key message here is retaliation, okay? So the dynamics for inflation will very much depend on whether there is retaliation, and if there is retaliation, how wide is it? And that is all a policy uncertainty that we are, of course, at the moment, not really clear about and not aware about. But the good news is that the situation seems to be de-escalating. And that means that the damage to confidence that we've seen so far might not be that strong to undercut the real activity in the economy massively. But the risk of flat, shallow, short recession is, in my view, still very significant. Maybe not for the euro area as such, but for specific countries by all means. So overall, the lack of growth is the key story here. But in my view, that is a very clear opportunity for Europe. And that is not only related to the defense sector, where we need to step up our investment and our ability to defend ourselves, and also boost confidence and military industry manufacturing through this move. But also, this is, in my view, a very clear call, and the ECB has been very vocal on that in the past, and myself as well, is, okay, let's finish the architecture. The institutional architecture of Europe is still unfinished. Right. We have one monetary policy, but we still need banking union, capital markets union, single market and services, at the end of the day, common fiscal facility to unlock the growth potential that we have.
And yet, when it comes to potential deals in the banking space, those seem to be getting harder and harder by the day. But I would like to get your thoughts on the role of the dollar to some extent. I was reading that nearly 1/5 of Eurozone banks' funding needs are dominated in US dollars. I'm just wondering whether you think that there's a potential risk here and therefore they should cut their exposure on that front. And to what extent can the euro actually be a solid, safe haven answer to some of the concerns we have seen on the greenback recently?
We've seen that there's been some move away from the dollar. Okay? But the problem, of course, is that the ability to move into other assets is relatively small. And that means that the US dollar, even if there is going to be some adverse reaction, is going to remain by far the reserve currency. But that, again, is an opportunity for Europe to strengthen the international reserve role of the euro. But that, again, asks for safe asset, for much deeper financial markets. And that is of very clear benefit to the European economy. So I think, of course, all the financial institutions should be looking into various risks at the moment, but we've seen financial markets being quite resilient. We haven't seen massive stress levels in the markets. Of course, precautionary moves are always of value, but let's not exaggerate. Okay? We see some elements of stress, but this is not falling apart of the international financial markets, by no means.
Well, we appreciate your time today. Thank you for joining us. Martins Kazaks, the European Central Bank Governing Council member, and of course, governor as well from the Central Bank of Latvia.